Hello, good afternoon. Welcome to Mutual Fund Corner on CNBC TV 18. I'm Vinnii Motiwala and thank you so much for tuning in. Today, what we're going to be discussing is going to be whether you should be investing in those pharma and real estate mutual funds. We've seen both these sectors and that has seen a very sharp fall coming in the last 6 months specifically, and YTD also. If you look at the performance of these sectors, that has been quite weak. Recent market fall, does it give you an opportune time to actually start investing in these two areas? And especially those thematic funds which are focusing on real estate and pharma. Does it make sense to start looking at these funds given the correction? What are the pros and cons of investing in these segments? We'll discuss all of this with Rushabh Desai, founder at Rupee with Rushabh Investment Services, joining with us to talk to us about that. Rushabh, thank you so much for joining with us on the show as always. And let's just get started by talking about these two segments and sectors specifically. Pharma, real estate, both of them seem a fall coming in. When you're looking at it on a YTD basis, Nifty Pharma down almost 14%, real estate down 21%. And with that, when you're looking at those mutual funds which are specifically thematic in these funds, have seen a bit of a decline last 2-3 months. They've given those negative returns as well. Given this correction that you're seeing, is it time to actually start looking at these funds?
Hi, Vinnii. First of all, thanks so much for having me on the show. See, let's look at the data first and let's look at the underlying fundamentals of both of these sectors. See, number one, Nifty Pharma Index has fallen around 14-15% from its 52-week high. Nifty Realty Index has fallen around 30% from its 52-week highs, right? Number two, has the valuations become reasonable? Answer is a yes. See, valuations of both of these sectors are trading close to their 10-year average. Now, the real estate valuation, the 10-year average has been around 30.4. The current price to earnings as on month end, as on Feb end, has been around 31.9. On the other side, on the healthcare sector, the 10-year average P of the healthcare sector has been around 27p, and the current month-end P for February is around 28.7. So from a price point of view and from the valuation point of view, technically, yes, contra-tactical bets can be taken in both of these sectors.
Okay. Contra-tactical bets can be taken, but from a mutual fund perspective also, these themed funds, despite that negative return in the short term, does it merit to start an SIP right now for this?
Vinnii, answer is a no. There are 2-3 reasons for this. See, I see more advantage taking exposure in these sectors via diversified mutual funds, which is multi-cap, flexi-cap, focus, mid-cap, small-caps, etc. Now, SIP usually doesn't work that great in sectorial funds is because of the cyclical nature of these sectors. Because these sectors can go dud and can give zero or negative returns for years at a stretch. That is what the historical data has seen. So entry and exit is absolutely very important in these sectors. See, from these current levels, there is a good amount of margin of safety, but still we don't know how the recovery will pan out to be. Whether the recovery will take 6 months, 1 year, 2 years, 3 years, we really don't know. So my humble suggestion is that, rather than taking sectorial bets, in terms of SIP, if someone really wants to take sectorial bets, then lump sum methodology works great. But SIP really doesn't work great in sectors.
Okay, it doesn't work great in these thematic kinds of funds. What I also want to understand, Rushabh, is in terms of these pharma as well as real estate mutual funds that we were looking at. How does volatility compare in terms for both these as well as the risk versus other sector focused funds? Is it a bit more different? Is it a bit more volatile versus other sector focused or thematic focused funds?
Vinnii, this is a brilliant question. See, the real estate sector will be and has been more volatile and cyclical as per historical data compared to the pharma sector. See, let me give you and your viewers some very interesting data. See, on a 5-year daily rolling returns basis from 1st Jan 2012 to 7th of March 2025, which is around 13 years, right? The average returns of Nifty Pharma is around 12.8% CAGR on a 5-year basis, right? And the average 5-year returns of Nifty Realty Index has been just 1.5%. So in terms of volatility and cyclicality, the real estate sector has been much more volatile and cyclical. Pharma has been comparatively stable. See, let's also look at the drawdowns on a 5-year basis. See, the minimum returns over the past 13 years on a 5-year rolling basis has been minus 12% for the Nifty Pharma index and minus 30% for the real estate sector. So yes, both of these sectors are going to be super cyclical and volatile. So timing is absolutely very important. As I mentioned earlier, that yes, from these levels, valuation seems to be very reasonable. So there is good amount of margin of safety, but it only time will tell how the recovery and the bull phase will turn out to be in both of these sectors.
Obviously, that recovery is going to be key for both these sectors, and when will it come in? But, for the long-term perspective, if you do start seeing a recovery, does it make sense to invest in these two ones, pharma as well as real estate? For the long-term growth, I have 5 years, 10 years holding period. Then does it make sense to invest in such a mutual fund or a thematic fund?
Answer is a no, is because that these funds will be quite restrictive to only two sectors or these themes, which is the pharma, healthcare, and the real estate, right? Now, if you give more liberty in a fund, which is like a multi-cap or a flexi-cap fund, right? The fund manager will have more liberty over the period of 5 to 10 years to churn the portfolio in a much more effective way, right? So I think giving more flexibility in a product makes more sense. See, I am not saying that there will be no upside opportunity in both of these sectors. We are a very emerging economy, fast growing economy. So every sector will do well in pockets, right? But it's very difficult to identify those pockets and very difficult to see how the recovery and the bull phase will turn out to be. I think it's best to leave this up to the fund manager to decide very precisely when to enter and exit in these particular sectors. So my bets will go on to the flexi cap funds and the multi cap funds at this point of time.
Okay, flexi-cap and multi-cap funds. And, Rushabh, what if someone is already holding these funds? Then what do you do right now in such a time? Now, I'm already in it. Then should you get out of it right now or continue to be in a Nifty Pharma related kind of a mutual fund or a Nifty real estate mutual fund?
I think right now being patient is the wise thing to do. But there is another way to look at it from a tax harvesting point of view. See, if you have made decent amount of gains this year, right, since we have some time till 31st of March. So if you have made a decent amount of profits, capital gains, right, I think then booking losses depending on the gains what you have made, so that the gains are reduced, so that you don't need to pay more capital gain tax, and entering in flexi cap funds or multi cap funds would work great. But if someone doesn't know how to follow this tax harvesting methodology, then being patient at this point of time is something what I would really encourage.
Okay, Rushabh, being patient, that's the key right now in the market. So surely be patient, wait out and hold on to what you're holding on to. But on that note, viewers, we're going to slip into a very short break. We have discussed real estate as well as pharma-related mutual funds. Not a good bet is what Rushabh is saying right now. But on the break and after the break, what we're going to talk about is balance advantage funds. What are they versus a Nifty 50 fund? What makes sense that you should be looking at in this current scenario? So stay tuned in for that. Welcome back. Thanks for staying tuned into Mutual Fund Corner on CNBC TV 18. We still have Rushabh Desai with us, who's now going to talk to us about balanced advantage funds as well as Nifty 50 funds. What is the difference between that and which is a better option? Rushabh, let's just start with the basics. Balanced advantage fund and a Nifty 50 index fund. What's the basic difference between these two?
Vinnii, the basic difference between BAFs and Nifty 50 fund is that the Nifty 50 fund is a pure equity fund. Okay, it is going to invest in the top 50 companies of India as per market capitalization, which is a large cap index fund. Now, on the other side, a balanced advantage fund is a hybrid fund. It has two components in it. One is equity and another is debt. Now, this component, both of these components are dynamically managed by the fund manager. Means if the markets tend to get expensive, then the fund manager will reduce exposure from equity and take more exposure in debt. And when the markets turn out to be reasonable, which they are at this point of time, the fund managers will increase more exposure in equity and reduce exposure in debt. So basically, Nifty 50 is a pure equity fund, and a balance advantage fund is a hybrid fund between equity and debt.
Okay. Sorry, beg your pardon, Rishabh. But yes, moving on to talking about the risk-adjusted returns for both these, how are they different on that front?
Balance advantage funds, since they are hybrid funds, they are meant for moderate risk takers, who do not want to take too much of risk, who do not have a very long-term time horizon, who wants, lower volatility, lower drawdowns compared to pure equity funds, and who wants consistency in returns over a longer period of time. See, balance advantage funds, if managed well, are a very sweet spot products from a risk and returns point of view, because they are dynamically managed between equity and debt, and both of these components, balances out the risk and returns over the short, medium, and long-term perspectives.
Okay, Rushabh, is there some difference in terms of liquidity also? Is it that, a balance advantage fund or a Nifty 50 index fund, one of them would be more liquid versus the other?
No, the answer is a no, because in balance advantage fund, it depends on what the underlying debt papers are. See, if the equity and debt component in the balance advantage fund, say like the equity is large cap oriented, and the debt component is sovereign graded and AAA graded, then there will be no liquidity issues in my sense. Same with Nifty 50. Nifty 50 is a pure large cap index fund, and there is ample of liquidity in the large cap space. So if in terms of liquidity, I don't see an issue, but provided if particularly the BAFs are maintaining large caps and the debt component BAFs has to be AAA and sovereign.
Right. Rushabh, historically, which one has given a better return, right? Because for BAF, when you look at it, obviously, the fund manager can give different allocation. Nifty 50 is obviously those Nifty 50 stocks. So historically, has it been that, BAF does give better returns? And is it also depending on the cycles, like a bull market or a bear market? Are there different scenarios in both these cycles?
Absolutely, Vinnii. Let me come to the second part of your question first. See, theoretically, BAFs will do well in terms of bear markets or in terms of market volatility, because BAFs do have good amount of a portion into the debt segment. So when the equity markets fall dramatically, BAFs will comparatively fall lesser because it has a debt component in it. So during bear markets, BAFs tend to outperform. But during the bull market, pure equity funds will do tremendously well. Here's a very important point what I want to make to you and your viewers, that BAFs need to be managed well. See, there are two types of strategies in BAFs. One is pro-cyclical and one is counter-cyclical. See, pro-cyclical BAF products will be more aggressive, will be more tilted towards equity, and counter-cyclical strategies will be more valuation conscious. So they will, may not be as aggressive in taking equity calls, but both of these strategies work well during market drawdown. So in bull markets, pure equity funds will do tremendously well. And in bear markets, you will see many BAFs outperforming the pure equity funds. Vinnii.
Okay, that's interesting. Rushabh, diversification-wise also, BAF will offer better diversification, I believe, right? Given that, they can make those adjustments. Overall, with Nifty 50 and BAF, when you compare it in terms of diversification, what is your opinion on this coming in? And in the current market scenario, BAF is better on a Nifty 50 index fund. What should we look at?
Vinnii, let me put it in a different perspective. See, if someone wants proper diversification and risk mitigation, BAF will not take care of your overall asset allocation. If someone wants to get their asset allocation done properly, then they will need to sit with a financial advisor or a distributor, and as per your goal, risk appetite, time horizon, you need to get your asset allocation done. So in terms of better risk mitigation and diversification, I think keeping pure equity portfolio and pure debt portfolio separate is the wise thing to do. From a diversification point of view, depending on one's time horizon and risk appetite, venturing into different funds within the equity asset class and debt asset class is something what I would truly encourage. Now, see, overall, as I mentioned earlier, that BAF is a product for moderate risk takers who cannot stomach too much of of volatility. But BAF will still have risk. It will still have double-digit drawdowns as per the market cycles. So again, you cannot consider BAF as your overall asset allocation because it will have severe drawdowns from time to time. But I would highly recommend that having a different equity portfolio and debt portfolio for better risk mitigation and diversification is something what I would do.
Okay, one important point from me. So what should one investor choose right now, and any options that you could give an investor as well, which is the best among maybe a BAF or a Nifty 50 index fund that one could look at?
See, there are certain BAFs who have fallen as low as Nifty 50. So this is what I would suggest, that if someone has risk, if someone can take risk and someone has 3 to 5 years, or probably let me put it in this way, 5 years time horizon, then venturing into pure equity mutual funds, whether it is Nifty 50 or mid cap, small cap, flexi cap, is something what I would truly encourage, because we are at very lucrative price points today. Valuations have also started to turn out, in large cap, the valuations have turned out to be very reasonable. Mid and small caps also, the valuations have started to look quite reasonable at this point of time. So if someone has a 5-year time horizon and someone can stomach volatility and take risk, I think good amount of money will be made in the pure equity segment. But if someone cannot stomach too much of volatility and is scared of the severe drawdowns, then I think venturing in balance advantage funds is something what I would encourage. There are two balance advantage funds in my recommendation list. One is the Edelweiss Balance Advantage Fund, which is a pro-cyclical strategy, a little bit aggressive on equity. And second is the ICICI Prudential Balance Advantage Fund, which follows a counter-cyclical strategy, which is more valuation conscious. So I think investing in these two funds in equal proportion would be a good portfolio for balance advantage funds, Vinnii.
Okay, Rushabh, thank you so much for, giving us the two names as well, and what a viewer could look at in the Balanced Advantage Fund side, as well as thank you so much for joining in with us on the show as well and giving us an in-detail explanation in terms of BAF as well as the Nifty 50 Index Fund. But with that, viewers, we're absolutely out of time, so thank you so much for tuning in.